Hello, and welcome to this month's View from the Lighthouse. I am David Hansford, Executive Director and Portfolio Manager at Long Beach Capital. I'm excited to let you know the Long Beach Managed Prescient Fund recently won 2 awards: the Raging Bull Certificate for the Best South African Multi-Asset High Equity Fund for straight performance over 3 years to 31st December 2025, and the Profile Unit Trust Award for Best South African Multi-Asset High Equity Fund for straight performance over 3 years to 31st December 2025. The Long Beach Managed Prescient Fund is Regulation 28 compliant and designed for investors in the accumulation phase of retirement saving and who looking to maximize growth opportunities. This month we are taking about geopolitics and the opportunity in growth and technology shares. I am no expert in geopolitics or war and have no special insights into how either the US and Israel's war on Iran or Russia's war on Ukraine will end. War is abhorrent. Without diminishing the human suffering and costs of these wars, this article focuses on the economic and investment implications for our portfolios. The US and Europe may have limited incentives to push for a resolution of the conflict in Ukraine. Strategically, the war in Ukraine keeps Russia, a major geopolitical adversary, tied up, and sanctions degrade the Russian economy, while in Europe and the US, increased defense spending provides economic stimulus. The US and Israel's war on Iran in the Middle East has a greater global impact, both in terms of the flow of energy products, global travel, and the number of countries affected. With the US midterm elections in November, Trump has a very limited window to prosecute his war, having previously campaigned in 2016, 2020, and 2024 on the promise of no more wars. While the long-term trajectory and outcomes of the war on Iran are unknown, the number of countries affected and US elections in November would suggest the large-scale active conflict is more likely to be limited in duration. Longer-term implications for the region and global geopolitics are unknown at this stage. In January and February, as the US sent aircraft carrier groups to the Persian Gulf and built up military assets in the Middle East, markets looked to the Russian invasion of Ukraine for a playbook of what might happen. What followed was growth or long-duration equities being sold, defensive and quality equities outperforming, and gold hitting new highs. While oil and energy prices spiked after the Russian invasion of Ukraine and inflation increased. This came on the back of significant COVID supply chain disruptions, which were already contributing to the increase in inflation. In contrast, prior to the war on Iran, inflation has been declining and AI investment is increasing productivity growth. There are significant incentives for this new conflict to end in the short term, which may be restraining oil price increases. Already, less than 2 weeks into war, Iran is allowing tankers from non-aligned countries to pass through the Straits of Hormuz, and the IEA announced its largest ever emergency oil stock release, with 32 member countries agreeing to supply 400 million barrels over 120 days from global stockpiles. The inflation impact from the US and Israel's war on Iran may prove to be substantially more muted than in 2022. Software and other technology shares were sold off aggressively in January and February on fears of AI disruption and how AI and vibe-coded apps will potentially disrupt established business models. While we are certain to see new business models and apps built with AI emerge and go on to become runaway successes, many of the established software and technology businesses will be able to exploit AI to become more efficient, improve their products and services, and entrench their competitive positions. Software not only performs specific functions for a business, but it also acts as a system of record and ensures data sovereignty. AI requires both unique data as an input and widespread distribution as an output to create a business advantage. Large technology companies, software, and platform businesses are best placed with both these factors, having unmatched proprietary data sets and established customer relationships to deliver AI advantages. After an initial bout of volatility in global markets on the Iran war, growth and technology shares have started to recover counterintuitively. This is a good indication growth and technology was priced for excess fear. As always during periods of heightened volatility, we have adjusted our funds portfolios to take advantage of new opportunities. Growth and technology shares currently offer highly attractive valuations and future growth prospects. The Long Beach funds are invested in innovative, well-managed growth businesses, which are aggressively exploiting AI and have both substantial data advantages and extensive customer relationships. We are encouraged for the future potential returns from our holdings in the Long Beach portfolios. Thank you for listening, and join me again next month for another view from the Lighthouse.